rising inflation and rising interest rates, how they're connected, and what you need to know is going to be on this episode of the Henwood Edge. Hi, I'm Chris Henwood, and welcome to the Henwood Edge. All right, today, like I said, that's what we're going to talk about, inflation and interest rates. We all have heard on the news how news stories, inflation has been going up, and we've also heard that mortgage interest rates are going up. So interest rates are going higher. Why are they happening? What you need to know. We're going to cover all of that. Okay, some basic facts. We're in a rising rate environment. Right now, interest rates are starting to move higher, and I believe they're going to continue to move higher. How high? That'll remain to be seen. Inflation is at the highest level it's been in over 40 years. That's something that's pretty important because inflation can affect interest rates, and we're going to cover that. So the first thing we're going to talk about is inflation. What is inflation? All right, basically a definition here for you: general increased price of goods and services in the economy. Each unit of currency can purchase less goods and services, results in less purchasing power, meaning that things cost more, the money that you have buys less. It's pretty simple, it's pretty straightforward. I learned this in Economics 101. So that's what we're looking at right now. Now, I pulled this chart out of a Bloomberg news article that I found, and it's using data from the Bureau of Labor Statistics, and this is up from December of 2021. So you can see across the country, inflation is running at 6.3% up to 8.1% and higher, and you can see how it's interesting regionally, the different amounts that the different interest rates that are being, or inflationary impact is being felt in different parts of the country. So I just thought this was a really good kind of illustration of what everyone's dealing with across the country in terms of how inflation is affecting their lives. Now, what goes into inflation? What's causing the inflation to be at these numbers? The first thing we want to look at is the consumer price index. This reflects all the things you pay for: food, groceries, gas, other household items, medical care, education. It's all reflected in the cost that you're paying for it. Now you can see where it's basically bounced between 0 and 5 going back to 2001, but now we're looking at we broke above 5%, we're heading toward 10%, and it kind of doesn't look real good right now. That just means that everything is going up in cost, and we've seen that, we've all experienced it, felt it in our lives and in our pocketbooks. Now, behind the consumer price index is the producer price index. Now that's the stage before it gets to the consumer goods. It's the cost of production and what underlies goods and services that are provided to those people who manufacture and create. You can see that number has jumped very significantly in a very short period of time. Going back to just a year, you can see how significantly that's increased. What does it mean? It just shows you that the things that are providing the foundation and the raw materials for the consumer goods are also going up as well. Now, one other element to all of this is the Federal Reserve. You'll hear on the news a lot of times when the Fed is, has a meeting and they're going to raise rates, and it's a big news item because it impacts all of our lives. A couple of things I wanted to cover though. In 2022, they've announced they're going to have probably 3 interest rate rises, possibly 4. That's something that's very much widely accepted. The Fed funds rate. Now that's something that we should talk about, because what does the Fed actually do? They raise the Fed funds rate, and the Fed funds rate is the rate that banks borrow at. That's when they borrow from the Us Treasury. They borrow the money from the Fed, and therefore that rate goes up. So as you can imagine, if the banks are paying more for the money that they're getting, then they're going to charge you more for the money that they have just paid more for. So it's a kind of an ongoing process. Now, it has an indirect influence on mortgage rates. It's not a direct correlation that if the Fed raises it a quarter point, interest rates are going to go up a quarter point. It can actually have a varying effect to those two things. And the Fed uses raising interest rates to combat inflation. So when inflation gets too high, they raise rates, which is supposed to pull some of the steam out of rising consumer prices. Whether that works perfectly or not will remain to be seen, and we'll see it in 2022 as they raise these rates and see if they can't get some of that inflation under control. Now, how that translates from inflationary pressure and CPI and PPI and the Fed into mortgage rates is reflected in the interest rate, is reflected in the instruments that are used to determine what those interest rates are. Now, this is a mortgage-backed securities index. I get this chart from MBS Highway. It's a service I subscribe to that I think is fantastic. I use this to kind of help gauge, and my clients gauge, where they should be locking in interest rates and which direction interest rates are going. As you can see, this chart doesn't look too good right now. So when bond prices or the bond index is going down, that means interest rates are going up. It's an inverse relationship. So this is a pretty grim picture right now. But one thing I'll say is, and I'll cover it at the end as well, is markets don't move in a straight line. Right now we have a trend that's going down, but there's going to be variations and fluctuations where you'll see some dips in interest rates and you'll see some increases in interest rates. And you keep your eye on that as well. Now, this is another chart. This is the 10-year US Treasury Note that is also widely kind of looked at and monitored for mortgage interest rates. You can see here, now this chart is going up. So you might say, hey, well, that's great. This chart's going up, the other one's going down. However, unfortunately, this chart tracks the yield of the US Treasury Note. So yield, same thing as interest rate. Therefore, this goes up, interest rates going up. Again, same sort of negative picture for rates, although it's a positive moving graph. So it's just something that I wanted to share, that these are the things that I look at and that, mortgage professionals and mortgage banks look at in terms of understanding which way the interest rates are going and where they are at the present time. Now, here's a chart that goes back just a year. Freddie Mac puts this out. It's the average weekly market survey. Now, keep in mind, one thing I want to say is I'll get phone calls a lot of times from somebody who sees a news item on TV where they talk about, oh, interest rates have just dropped. Isn't that great? And you have to keep in mind, what they're talking about is always old news. It's always what happened like a week ago or sometimes a month ago in terms of what the reporting is, because it takes time for what people are doing now in the current time. Like I said, those other two charts, those are daily charts that reflect market movement that directly affects interest rates right now. These charts show you what took place a week ago. So just to keep in mind, when you hear it in the news, it's probably something that they're talking about that happened a week or plus, longer ago. So as you can see on this chart, we've actually broken out of where we've been over the past year, and we're shooting up to 3.5% and most likely higher. All right, now I put this chart up. This was something that I did a show about a year ago where we talked about prices and the effects, and you can see what was forecast for 2021 and then 2022 in this chart going back 5 years. Now you can see 2021 is probably pretty accurate because rates were below 3%, around 3%, but they have 2022 is going nowhere near the 3.5% mark. As you can see, we've already achieved it in the other chart. I just thought it was interesting to show you in comparisons, because here is the actual 5 year, same scale of time going back in the same chart, but you can see, what did 2022 do? Well, 2022 is starting off, breaking out of that forecasted trend. So this is something that wasn't really forecast a year or so ago, and now the reality is that inflation is affecting interest rates. Interest rates are going higher. But I wanted to give you from some perspective. Now, this is a 30-year chart that Freddie Mac puts out. And this goes all the way back to 1972. This tracks your average mortgage interest rates for various ones: 30-year fixed, 15 years fixed, and your 5/1 ARMs. Now, right now you can see, yes, we've jumped up a little bit here, but if you look at it historically, we are still very, very near the low end of the scale. So interest rates are still very, very favorable. They're just not as good as they were over the past year. So just to kind of give you some perspective, people bought houses all the way through here. I bought my first house right here, 9.25%, 1991. So that was the first house, the first mortgage I got. And you can see, it's trended lower from there. But I just wanted to give you some perspective to say that even though rates are rising, it's not the end of the world. The sky is not falling here. Okay, now some key takeaways. Interest rates have risen, and they're most likely to continue, okay? And rates are historically still on the low end. Now, interest rates fluctuate like all markets. And before I said, remember, markets don't move in a straight line. Interest rates are the same way. I've been talking about rising rate environment. That means that rates are going to move higher, but they're not going to move in a straight line. So you're going to have times where there's dips in interest rates, and when you're looking for houses and you're trying to lock in your rate, you're going to want to look for those dips, but I wouldn't hold your breath and hold out for them, because we don't want you to panic. But I think the best strategy right now is to, when you're under contract, when you get your house and you're under contract, go ahead and lock in that interest rate as soon as possible, because right now you're most likely to have it rise than fall, way more likely to have that happen. And I think that's just sound advice for the environment we're in right now. So toward that end, as we always say here, there's no such thing as a one-size-fits-all mortgage. Give me a call. We can talk about your situation. We can talk about, what your particulars are, what your risk tolerances are, and how much you're qualified for. And there's my phone number. Don't hesitate to text or call me. And I look forward to seeing you all next time on the Henwood Edge. Thanks.
Not a commitment to lend. All loans are subject to credit review and approval. Not all loan programs are available in all states. Contact a North Point Bank loan officer for further details.